Trump's plan to eliminate capital gains tax, impact on homeowners explained. Trump has suggested he may consider removing capital gains taxes on home sales, which would have significant implications for homeowners. Here's what this change could mean. Insert details about potential benefits and drawbacks. CNN reports that in comments Tuesday, President Trump expressed support for eliminating such taxes. He stated, "We are thinking about no tax on capital gains on houses." Later, Representative Marjorie Taylor Greene of Georgia shared her thanks to Trump for his support of a bill she introduced this month, calling it an elimination of capital gains taxes when selling primary residences. Will anything happen? Who knows? Especially since Trump signed into law a major tax and spending cuts bill that estimates deficits will rise by $3.4 trillion over the next decade, while simultaneously reducing health insurance coverage for 10 million people. But if Congress seriously pursues this idea, it's worth reviewing how current capital gains taxes work and who would benefit most if eliminated. If you sell a primary residence and realize a big capital gain, meaning you sell it for more than you originally purchased it after accounting for closing fees and qualified improvements, you may owe at least some of that gain. However, this depends on factors like the time between selling and buying, your income, and whether you lived in the house as your primary residence for at least 24 months within 5 years before the sale. Any gains above these thresholds are subject to long-term capital gains tax. Additionally, if you don't meet eligibility criteria but had to sell your home due to a change in employment, health, or unforeseen circumstances, you may receive a break on the capital gains tax. The IRS notes that capital gains tax rules differ when selling second homes or rental properties. In 2025, filers will pay 0% capital gains tax on gains above the exemption threshold if their taxable income is below $48,350. Or $96,700 for married individuals. If their income is between $48,450 to $533,400, or $96,700 to $600,050 for joint filers, they will pay 15%. A 20% rate applies to those earning above these thresholds. Long-term capital gains tax rates are usually below the ordinary income tax rate. Since the exemption thresholds, up to $250,000 and $500,000, haven't adjusted for inflation since 1997, many homeowners, especially older ones, may still face taxable gains even if they live in areas with high prices today. Generally speaking, 3 categories of home sellers are most likely to pay capital gains tax if they make out well. List categories. A recent NAR study estimates that 29 million homeowners already exceed the $250,000 cap, while 8 million may exceed the $500,000 threshold. Looking ahead, NAR predicts close to 70% of homeowners will have gains exceeding $250,000 and 38% will exceed $500,000 by 2035. The report highlights that in states like California, Massachusetts, and Colorado, the trend is even more pronounced. NAR argues that current caps may discourage homeowners from selling. Over the past 28 years, home price inflation has eroded these exclusions, the report states, particularly for older homeowners who've lived in their homes for 20-plus years. At a time when many are downsizing or moving to retirement facilities, more are facing gains far beyond the exclusions, which can result in thousands in taxes and reduced affordability for new homes. Meanwhile, the Yale Budget Lab finds that only a small portion of homeowners currently benefiting from capital gains tax elimination are wealthier, higher income, and older. In 2022, homeowners with gains above the exemption had an average net worth of $5.7 million, while those without were just over $1 million.